Good morning. Happy Friday. Thank you for joining me today. I'm really happy to finish out this week with you guys. And I want to do a quote real quick from Mr. Watson. Where are you at, Mr. Watson? But Mr. Watson has a great quote for what's going on right now in the economy. And it pertains to people that have recently purchased. And the quote is, those people that are dating the rate, their mortgage rate, must like abusive relationships. Because right now, you guys, the 10-year has absolutely exploded once again. And the reason is consumer spending is still out of control. Or is it government deficit spending that's out of control? Or is it both? Regardless, you guys, we may have a second round of inflation. Now, I've been noticing, and what we're going to cover today, I've been noticing in many markets that I've been tracking, we've seen a bit of an increase in activity, even in my own market here that I've been watching in Kingwood. So we have seen an uptick, you guys. Now, here's the reason why I'm saying that. Okay, this uptick has been ahead of normal spring home buying season. So to me, that's concerning. But the reason I'm telling you that again is you're going to hear a lot of noise going into the remaining part of this year and into elections. And having said that, remember this, your decision to purchase a home is yours and yours alone. The best that I can do is provide you guys with tools and a gateway to empower yourself and a cautious perspective and approach. But the thing is, guys, right now things are so crazy. Is inflation running away again, or is it just theatrics? Either way, you guys, I'm going to show you why interest rates are surging. But real quick, let me say good morning to everyone. Wally, what's up? What's up? Ima, Coors Light, Kevin, Voval, Millennial, appreciate you. Dean, where you at, Dean? Where you at, Mr. Watson? I was hoping Mr. Watson was going to be here. That one guy, what's up, that one guy? I hope you guys like my boots on the ground. I have been sick all week. I've only been able to record 2 videos this whole week, and they were collabs. I had planned on doing a lot more edits on those boots on the ground, but I'm doing the best I can, you guys. I still feel sick. You could probably notice it because I drastically need a shave and a haircut. I'm going to get started. Sorry for rambling. Let me put my first stamp on here. And we're going to get started on the mortgage rate update because mortgage rates right now have absolutely exploded. Here's why. So the reason why, and I'm going to show you the 10-year in a minute, is PPI is way higher than the market anticipated. Good morning, Sacred. Oh, my God. Good morning. Good morning, Christy. There's my man. Where you at, Trey? I see you, Trey. There you are. Hey, what's up, buddy? Oh, man, I love you guys. Oh, that one guy. There you are again. Appreciate you guys. Anyways, this is why mortgage rates have absolutely exploded today. You guys are going to see that once Mortgage News Daily updates in this evening, but PPI is a lot higher. This means that the inflation battle is not over. It could be theatrics, could be deficit spending. It's probably deficit spending, but consumers are still spending. I know that for sure because of the markets that I've been watching. They're ahead of spring home buying season right now. So thank God interest rates have a shot up. And also, you guys, the market's no longer thinking the first rate cuts in May. Did y'all hear me? I'm going to show you that in a minute, but regardless, you guys, this is the biggest increase in 5 months. PPI shows inflation fight not over. Let me show you what this has done immediately to the 10-year. We track the 10-year Treasury because that 10-year Treasury tracks residential mortgage rates. The federal funds rate doesn't track it. Think about it, you guys. We've had a 100 basis point swing in mortgage rates, and the Federal Reserve hasn't touched the one-night rate. Right now, I can't believe you did that. Right now, I cannot believe you did that, man. I'm going to, you know what, next live, dude, you told me not to do that to you on your next live. I'm going to do it. You guys, this is my mentor, Fish and Trips is Raynell. Raynell taught me all about YouTube when I was struggling and I started a fishing channel. This is my mentor, Fish and Trips. He's the guy that taught me how to do YouTube right there. Go to his YouTube channel. This guy is so entertaining. Anyway, you're going to make me start crying, Raynell. I can't believe you did that. Don't do that. Anyways, sorry, my boy threw me off, but look at the 10-year, guys. The 10-year is up 8 basis points right now. 8 basis points. And you guys go to Fish and Trips. I'm not joking. Go to this guy's channel. This guy's an absolute artist. I love it. This is why I have to go outside and can't stay in my studio. I have to go outside and create and be artistic. And Raynell is the reason why. I fell in love with cinematography. Anyways, you guys, the 10-year has skyrocketed up. Thank God we need this. We need people to stop spending. And we also need the government to stop printing and stop bailing out people and fighting wars, deficit spending, right? Anyways, blown up. This was even higher today, you guys, but this is back at the highs seen at the end of November. So we're back at the end of November with the 10-year. This is really good because we need, what have I been saying this whole time? We need elevated rates when we're going into spring home buying season. And I see that in the data because people are already buying ahead of spring. And I'm going to show you that. But look at the 2-year. 2 years also up. Now, the interesting thing is the 2-year was way up. It's gone down since market open. It's still up 8 basis points, but keep your eyes on that. This is kind of the liquidity zapper right here. That's that short end of the yield that so many people are investing in. Here's, again, the long end. This is killing and crushing people right now. The 10-year is supposed to be higher than the 2-year. Okay, that's what the inversion means. This is supposed to be lower than the 10-year, but it's higher than the 10-year, and that's the inversion. But look at mortgage rates, you guys. So here's yesterday's mortgage rates. So again, this is yesterday's mortgage rates. We're sitting at 7.03. So we're still in the 7%. Now this is going to update later today, and when it updates later today, mortgage rates are probably going to be about 7.15. So, go there in the evening to Mortgage News Daily, see what the update is. I'm guessing 7.15. We'll see how close I am. That's a 12 basis point increase. It's going to be high. It's going to stay in the 7s. We need it to stay in the 7s because, again, inflation is still out of control in some areas in the market, not all areas. Now, let me show you guys this. This is crazy. Look at now that the PPI report came out. Look what the market's doing. Okay, the market is like, again, remember last year, almost every single live I've did, I'm like, you guys, we need to make it to June. We need to make it to June. I'll settle for May. And then what happened in January and towards the end of December, the whole market flipped instead of our first rate cuts coming in March. Remember that? The market got completely wrong. They're still way too optimistic. Basically, you guys, next meeting is in March, and there's basically no chance for rate cut. They're saying elevation, 91% likelihood of elevated rates. Take a look at May. Now, remember real quick, we're at 525 to 550. Okay, so right now we're at 525 to 550. So remember that. Now take a look at May. This is insane. This is so good. This is so good because, again, we need to tamper down demand. So the market's saying 69. This is the highest it's ever been. Since I've been doing these lives and covering CME, this is the highest it has ever been. Thank God. This is exactly what we need because I see people already coming back to purchase homes, and I'll show you that. But right now it's saying May, 69% likelihood they do not cut rates in May. You guys hear what I said right there? Oh my God, right? Now look at June. Okay, now even June, this is great. This is great. So they're saying in June, 28% chance that rates stay elevated, but 53% chance, so a little bit more than half. Again, they always get this wrong, that they're going to cut rates in June. Okay, first cut, and that's a 25 basis point cut right there. You guys can see that. But when we go all the way to December, now remember, this is where we're at, 525 to 550. I really appreciate you guys. I can't believe you right now. Anyways, we're at 525 to 550 right here. So when I click all the way to December, basically here's where the market's at. So they're basically saying 30% likelihood that there are 3 rate cuts. Okay, so 25 basis point rate cuts. So 75 basis points total, but 29% likely that there will be 100 basis points worth of rate cuts, which you can say is 4 rate cuts of a quarter point. The market is shifting like crazy, you guys. And take a look at the 5-year break even. Now, this is one of the reasons why this, everything is changing, the expectations of inflation. And I hope we understand by now, and we see that when we look at the laws of supply and demand, the sentiment is so important. The emotion is so important. If people are emotional and they don't think anything bad's going to happen, they're going to keep buying. Sentiment is so strong. In fact, it bucks fundamentals. What's in people's head bucks fundamentals. It's crazy. Look at this 5-year break even. I mean, I haven't been going over this with you guys because it's been about the same, but this son of a gun has been skyrocketing. Remember, before they cut rates, this needs to be 2 or under. So if you guys want to follow the inflation expectations, just go to this 5-year break-even inflation rate. This is saying that in 5 years from now, the market expects inflation to be 2.35. Remember, the Fed wants it 2% or under. This has been ratcheting up. Look at this, guys. Look at this since December 28th in the market. Why was the market so optimistic? I don't get it. So since February, the last 2 weeks, we went from 2.17 to 2.35. I'm not saying expectations are unhinged, but this is not the direction that the Federal Reserve wants to see if they're going to start cutting rates. And that's the thing, you guys. The bullish narrative, the economy's doing great. The economy's doing great, so let's cut rates. That's backwards thinking. They're not going to cut rates if the economy's doing great. Now we know that, right? Now we know that. But then the other thing is, guys, is the economy really doing great? Or is it deficit spending from the government? What a situation. But take a look at this. I want to give you guys some value right now. We're going to go to the amortization schedule. And, well, you know what? First, let me explain real quick to you guys what a basis point is. So like when I say like things are up 7 basis points or 8 basis points, you got to look at basis points like a percentage. It's 1/100th of a percentage, which means 100 basis points equals 1%. So again, 100 basis points equals 1%. Hopefully that makes sense to you guys. But anyways, going into the amortization schedule, and what I want to do is I want to show you how to turn this into a 15-year loan. Say you're a recent homeowner, you're upside down in your house, but you want to pay off your loan early, you can't refinance. You can turn your 30-year loan into a 15-year loan without refinancing. Remember, when you refinance, you start the horrible amortization schedule all over again. Okay. And you pay, let's just round up to say about 4% in fees. So if your home went up 4%, you just wasted that by refinancing. You can turn your loan into a 15-year mortgage. So this is a 30-year loan right now, right? So $324,000 loan, 7.03% rate, which was today's rates. You're going to be paying a total of almost $500,000 in interest. So again, yeah, I mean, we get bullied. Oh, you're renting. Oh, you're going to stay in the sideline forever. You missed the opportunity. Everyone that says we missed the opportunity keeps forgetting that in order to get the opportunity, you had to face bidding wars, waiving inspections, no buying incentives, no inventory. You had to sacrifice your rights as a buyer. And I had a conversation with Jared Jones, and Jared was like, man, no, the savvy buyers came out in 2021. I don't think that. I think the foolish buyers came out in 2020 and 2021 and 2022, and they got lucky because the buying box was so big. The buying box was huge. That means anyone could buy a house. So I don't think that. I think the buyers that are coming back right now are actually the good buyers, the well-prepared buyers, because things are even more affordable. And the people that are priced out are going to stay priced out until something changes. So anyways, this is what you do to turn this into a 15-year mortgage. All you do, you guys, is you add an extra payment. Okay, so say you wanted to turn this into a 15-year. All you do on this loan amount, say add $750 extra per month towards your principal, okay? The advantage of doing this, one of the advantages is you're not locked into a 15-year mortgage payment. So the thing is with the 15-year mortgage is the payment is a lot higher than a 30-year. So by adding additional money towards principal, turning it into a 15-year, it gives you the flexibility of not being locked into a higher payment. So if you have any type of unemployment or loss of income, you could just switch back to the 30-year mortgage payment. But all you guys need to do in this scenario is add $750 a month towards your principal. So if you add $750 a month towards principal, you guys will save over the life of the loan $250,000. You guys add $750 to principal each month. Not only do you save $250,000, you also, look at this, you turned your loan into 15 years, 1 month. That's it. And you don't have to refinance. Y'all see what I'm saying? Now, if you could refinance into an interest rate that was maybe 2% lower, and you've only been in your existing amortization schedule for a year or 2 years, maybe it's beneficial, but you don't want to necessarily refinance into a 15-year mortgage if you've been paying your mortgage for 13 years, because you've almost already turned your 30-year mortgage into a 15-year, if you know what I mean, because the time you've been in your amortization schedule. So anyways, guys, adding $750 turns your mortgage into a 15-year mortgage without having to refinance. I hope that made sense to you. If that made sense to you, can you guys just type in amortization schedule, please? I really want to give you guys, I want to make sure you guys are getting the amortization schedule, because that is one of the worst types of debt you can get in. It's not like a car loan, although a car is an appreciating asset. So if you guys can, oh yeah, Mr. Watson, I already put this up in the beginning. I was waiting for you, bro. Where were you? But I already put it up in the beginning. But if you can, please type in amortization, or just type in A for amortization if that made sense. Because if it didn't make sense, I'm going to figure out a different way to explain that. But again, okay, well delivered amortization. Good. Thank you. Don't move. But if you guys can't put a capital A right there for amortization, I don't see many people putting the A, so I don't know if you guys are getting it. I hope you are. There we go, Christy. I see you. Okay. We got some A's in the house. Okay, good. All right. We're going to move on to our first video. Okay. Our first video is basically going to be going into commercial real estate. Now, one of the black swans that I believe that has spooked Jerome Powell is commercial real estate meltdown. I mean, there's literally a triple whammy. We got high vacancies. Okay. What else? We got high vacancies. Oh, we have way higher interest rates and we have falling values. That's a triple whammy. That is really bad. So this is going to be our first video. If you guys can, please let me know that the audio is okay.
Don, this sort of rolling real estate apocalypse has not happened. It has not come upon us yet en masse. Certainly some buildings. You and I have talked about this a lot. Right now, can you figure out the value of a building? I read an article this morning that one of the problems is that nobody actually seems to know what a lot of these buildings should be worth.
Well, I mean, I just heard Richard's comments, and Richard's a good friend. I saw him last week, and he's certainly very pessimistic about the market. I'm pessimistic about office buildings as well, but I don't think that the reason we're not seeing activity is because people don't understand value. I think we've got a good handle on the value of many of these buildings. If you operate from the perspective that office occupancy has changed forever until something else shocks the system, probably decades from now, we're going to have a hybrid workforce. And so that has had a major impact on office buildings. But this is different, by the way, than, say, the early 90s, because the banks don't have over leverage. They are at 60% of the values of those assets when they made the loan. So they can take a 40% hit in value and not be hurt. It's the equity that's wiped out, and it's the mezz lenders that are wiped out. And the banks just don't want to deal with all of these headaches. They were hoping things would change. They're not. So I think we'll begin to see more asset sales happening mid-year into the third quarter and fourth quarter, where we'll see a lot of activity, I think, in terms of commercial office buildings.
I heard a crazy story from a good friend of mine, somebody you probably know, but I won't say his name on the air. We could talk offline. And he told me a story which I thought was insane, but I can't prove it. You probably can, which is he was telling me the story about in New York City, a building, and let's say it was bought for $700 a square foot. Okay, it's somewhere around there. And it's in distress, and they just sold the building for like $350 a square foot. So the building was sold. The guy that bought it lost basically half his value. But in the real estate transaction, New York City valued the building at $703 a square foot, even after the sale at half its value, because they have to pretend this is not happening for tax reasons, for tax revenue reasons. Is that possible?
Yes, it is. In fact, I started in the real estate business as an appraiser and a consultant, and I built and owned the largest property assessment appeals business in Washington, D.C., and we prospered in the early 90s because the government was refusing to recognize that the massive decline in commercial real estate that took place. And so what's going to happen is the governments are going to force property owners to sue them and appeal their assessments and sue them to get their values lowered. And that's because they cannot afford the massive revenue loss. DC alone is going to be down $400 million in property tax revenues this year alone.
Wow. $400,000 in loss of tax revenue. And also, you want to know what's interesting? So they're saying that they're going to, about that video, that they were going to the government was going to force property owners to sue because of the overassessment of the values. I honestly think the same thing can be done for homeowners that purchase new construction. And honestly, that may be a way around the arbitration agreements. I'm not an attorney, but remember, you guys, they are required to be reporting the seller concessions. And we've heard multiple reports that they are not. So if the new home builders are not properly disclosing seller concessions on the appraisal like they are required to by Fannie Mae, then they just violated their contract. And if they just violated their contract, then no need to worry about the arbitration agreement and the special warranty deed. So you guys go after them. I don't know. That's what I'm thinking. I'm thinking that's the loophole. That's how you pierce the arbitration agreement. You did not disclose how much the value of my house really was. And that's going on in new construction right now. And with that going on, the values are still not sustained. Think about what I'm saying. We're going to move on to the real estate portion now, you guys. Now, I'm going to show you multiple things in this segment. We're going to go over investor demand. We're going to go over the new home data, and I'm going to show you guys a market analysis going into the weekend because I want you to use the fundamentals to find houses if you're buying right now. Now, after that, we'll watch one more video, and then I'm going to go into metro areas that appear to be rebounding ahead of spring home buying season because I want you guys to be aware of what's happening. So let's go into first this little segment right here, okay? Here's what I want to warn you guys about. So there has been an uptick. Now, first of all, look at investor purchases, okay? Investor purchases overall has plummeted downward. Right now, they're saying investors in Q4 of 2023 purchased 4,600 homes. I'm sorry, 46,000 homes. So that's been going down, but here's the problem, okay? So even though overall investor purchases have been going down, investor purchases for affordable housing has a new record high. So if you guys want this to stop, what's the solution here? I've been grilled, from both sides of the coin, like, oh, you want more regulation. I'm like, it's not that I want more regulation. It's just, what do you do about greed, corruption? What do you do about the greed and corruption and the lies? What do you do about that? Is it government intervention, or do you just hope people start becoming honest? Something needs to change. I don't know what it is, but there has never been such a high share of investors purchasing affordable housing. And that's probably what Jeff saw in his area and son of a gun right now. That's probably what Jeff was seeing in his area, because Jeff is in an area where he has affordable housing still relative to the rest of the nation. And it was a struggle for him. He actually did a love letter, and I think he said 50 or 60,000 on the love letter. But you guys, they are sucking up all the affordable housing, 26%. Think about what I'm saying. I mean, investors cannot stop. Think about that. 1 out of 4 houses on average is being taken by an investor. And honestly, it's a lot higher when you take into account there's clusters of investor demand. Fish and trips. I'm back. Keep grinding, Travis, because I know YouTube can be such a hard mountain to climb. So just keep taking it one step at a time till you reach the top. All right. See you on my next Camp and Cook episode. I'm out. I mean, dude, I can't believe him. I'm going to have to get him back. That's my mentor, you guys. That's my dude right there. Go check him out. I'm not joking. Check that guy out. He's amazing. Anyways, okay, so investors, something needs to happen here. Nothing happened. They're just going to continue to buy the most affordable housing. We see it right here. This is a record high. This is a record high. It has never been this high. This is crazy. So something needs to change. I want to show you what's going on. Take a look at the new home data. Now this came out this morning, you guys. This is new home data. Now, the first thing is let's look at permits. Now, permits did drop slightly. They're sitting at 1.47 million permits. It has been going down. It's been kind of steady since the start of this year. That's still right about where it was pre-COVID. So we're like pre-lockdowns right now with permits. Now, obviously, yes, I am saying that the prices are going down, quality of construction's poor, but we still need building. Right? We still need them to keep building. So it's important that this doesn't really drop too much lower, I would say. As long as it stays above like 1.3, I think that's fine. But take a look at this, guys. Here's starts. Now, what I did here, here's total units of starts. Let me show you guys. So this went down pretty drastically month over month. It was at 1.56. So we had a huge increase. That has plummeted to 1.3 million. So again, when you look at, pre-COVID, we're sitting at about where we were pre-COVID. We're still off the peak. So they're still building a lot. But take a look at this. Now it gets crazy when we look at actually units under construction. This is going back to the 1970s. So February of 1970 or January. So January of 1970. Under construction is a lot. So they got a lot going on right now. Never had so many housing units under construction. We're sitting at 1.67 million. This is one of the reasons why the rental market is going to go down. What you see right here is one of the reasons why. Now, when we separate, 5 units or more out, and we're only looking at single family units, we're sitting at 680,000. This is underreported. I'm going to tell you guys right now, it says on the Census Bureau that this is underreported. But regardless, we won't go there. Regardless, we're well above pre-COVID. So we're sitting well above pre-COVID. That's good because, again, this is single family units. Only looking at the single family units, we are off peak, but we're still sitting at 680,000 units. So that's actually really, really good. Now, here's the thing, you guys. Now, what I want to do is I want to do a market analysis. This is what it looks like. Okay. Let me plug this up real quick. This is going to be our market analysis. Basically, I want to show you guys cash flow, and I want to show you guys wedge, because remember what I'm saying, okay? Some people forget this. I don't know if he's online right now, but some people forget this. Every market's unique. Every market's localized. In order to really, really understand value, you can't really look at the macro picture, okay, or what's going on around the nation like I'm covering. I'm covering the nation and I'm covering the housing market in whole. I'm pretty sure everyone knows that, right? But when it comes to purchasing and when it comes to empowering and when it comes to you understanding whether or not you have a great deal, you have to go local. And so local, as long as it's not rural, you have to go subdivision. Because subdivision is its own thing. It's its own environment. It's segmented out of all the other noise. So remember, you have to go subdivision generally in order to figure out whether or not you have a great deal. And all we have to do is use simple math. It's not even hard to figure out if it's a great deal. The hard part is finding it, right? It's easy to figure it out, but it's hard to find it. So I want to do that right now, you guys. Now, the first thing, though, I want to cover here, how do I want to do this? Let's cover this first. So remember, okay, right now in Houston, this is the MLS right here. Right now in Houston, there's 20,000 listings. Let's just say there's actually more than that. Now, if you really want to narrow things down, you just set up your search. Say you want a 2,000 square foot house to 3,000 square foot house. You just put that there. Now, I made a special additional filter on my matrix, which is the price per square foot. Say you only want to see houses between $90 a square foot and $100 a square foot. Okay. 105 matches. Boom. Let me hit the map. I immediately know where these houses are. So I've taken 20, 30,000 comps and I've filtered it into 100. This is what home buyers should be doing, not using their emotions. And you guys can see now, I know there's one in Porter, Spring, Louetta, Atascocita, Aldine. But the thing is will you have to settle, right? That's the question. Will you have to settle right now if you're going to get a great deal? And the answer to that question more than likely is yes, you have to settle, because there's barely any that are fitting the good deal criteria. I mean, look at this. You know, there's hundreds of comparables in between these, but my point is it takes seconds to figure it out. This is where I did that video on undocumented workers right there. Man, that brought out the worst in people. It's a very polarizing topic, but look at this, guys. Now, I want you guys, if you can, give me a home to look for. Okay, we're going to do a market analysis on a home. Give me a price point. Okay, give me a price point, guys, and give me a size of a house. Throw it up in the comments. Give me a size of the house, and we're going to do a market analysis right now as if you all were customers and I was your realtor. Hypothetically, I'm not representing you guys. Understand that. I want a size. What size houses should we be looking at? 1,000 square feet. First one up. Someone throw it in the comments. I need size of house and I need price point, because we're going to do this together right now from scratch. Okay, here's someone. Okay, so we're going to go 1,700 to 2,700 and 5,000. Okay, so we're going to go, what was it? We're going to go 1,700, okay, to 2,700. And the price point, let's go maximum 500,000, okay? Boom, 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 boom. Do I not have my price point on this? Okay, so we're going to go this square footage. I guess, what the heck? Here we go. Sorry, guys. All right, so what was the price point? Up to 500. So let's just go 350, excuse me, to 500,000. Okay, let's go back here. Why is this not working? Okay, do my little spaces in between. It's not working. Sometimes this happens. Let's go coming soon option. Okay, let me refresh the screen. It time out sometimes. All right, so we're going to do this again. 1,700, okay, to 2,700. Okay, so we have over 5,000 matches. You can't see that because that's where my picture is. So now it's working. We're going to go 350. Okay, and we're gonna narrow this entire fill down and do a market analysis to 500,000. You know what, guys? I'm just going to exit out of this. We're just going to do square footage, okay? And let me go to results. So we're just going to do square footage for right now. I don't want you guys to wait. Now, I have over 5,000 listings at that square footage, okay? So all I'm going to do, remember, this is where I'm starting. I'm starting with price per square foot, all right? Sort limit, oh my God, because there's too many comps, I can't do that. Let me just go back here, okay? I'm just going to do this one more time. We're going to go 1,700 square feet. Okay, to 2,000 square feet. I'm getting too many comps. Still. Oh my God, there's so many comps. Okay, I'm gonna do this. I'm gonna filter the price per square foot. Let me say $100 to $125. Okay, there we go. Now let's look at the results. All right. So apologize, you guys got to see me work on the fly. All right. So now we have 232 homes. Let's go to the price per square foot. Now we have it categorized in price per square foot. You guys see that right here? Now I've kind of taken 20,000 homes. I filtered it live on camera right now. And here's all the houses that meet that criteria. So let's just start and let's just see if there's a good deal on the first house right here. Okay. So the subdivision we know is Gulf Terrace. Let me pull this up. Let's take a look at this house, okay? So this is a house that has one of the best deals. This one's 43 days on the market, and there has been a recent price cut of $5,000 that happened 2 days ago. So when I first look at this, I'm like, okay, these people will play, right? As a buyer, when I see this, or an agent, I'm like, okay, we can negotiate here. 43 days on the market, they're already price cutting. It's listed, very, very low. But what I want to do is I want to pay attention to the subdivision. Okay, which is where's my stuff? Okay, which is the Gulf Terrace. And then I want to look at the size of the house. Remember, you guys, the size of the house is very important. Okay, so the size of the house is right here. This is 1,748 square feet. The purchase price is $175. And remember, we're doing an analysis, so we got to see what the property taxes are. So property taxes are almost $5,000 a year. Isn't that crazy? Okay, for taxes. All right. Now, what I want to do is I'm going to go back to my matrix, my search criteria, and we're going to do a market analysis on that subdivision. So I'll put the subdivision here. Okay. So now I have my subdivision there. But before I do that, I am going to update this. Okay. So what do we know? Okay. So we have a home. So we're going to put the purchase price. By the way, we're doing a market analysis for subdivisions based on 365 days of comparable data. A comp means a home sold. So when you guys hear the terminology comp, that means home sold. So purchase price is $175,000. Okay. The square footage is, see how this is just so easy, 1,748 square feet. And the taxes are per year, $4,000. That's so high, $781. All right. So that's some key pieces of information right there. But again, we need to figure out, you guys can't see it, but we need to figure out the bottom wedge and cash flow. So now that I have my property characteristics, what I need to do now is I need to make sure that I'm getting my characteristics for the subdivision. So I'm going to go back here. Let me flip this actually like this. Okay, so I'm going to flip this, guys. So again, I want to search the Gulf Terrace subdivision, and I'm only going to go over the 365 days for the sake of time. Remember, you guys, I will break this down to years, 2022, 2021, 2023, but we're only going to look at the last 365 days for Gulf Terrace and the properties that have sold, all right? And of course, nothing's coming up. Let's see if it was 650 days. So sometimes there's been some issues with the matrix. Let me paste this here again. Let's see if anything comes up now. Okay, so one match. Let's go to sold. Oh my gosh, I got nothing in that subdivision that has sold. So there's legit like nothing that has sold in that subdivision. Let me do so in the last 800 days, this is a hard one. I can't figure it out here because I only have one subdivision. I only have one comp in that subdivision. Let's look at results. And that one comp sold for $132 a square foot, and it's actually about the same size. So I'll base it off of this, you guys. I'll base it off of just this one comp, which is not good. You don't want to do that, okay? But let's switch this now. But I'm going to go back to this form, all right? And I'm going to put last 365 days, price per square foot. You guys understand what I'm doing here? I'm giving you an example because that subdivision has no comps or sold property, it only has that one. So the price per square foot was $132.72. You guys follow me? Now what I'm going to do is I'm going to go back and I'm going to look at the rental market. Let's see if the rental market has any comps as well. This is so easy. You basically do the exact same thing, but you just look at the rent. Let me copy and paste the subdivision. Okay, Gulf Terrace. Okay, my gosh, this is crazy. There's nothing. I'm going to go 800 days back again. There's just nothing in the subdivision. I have no rentals in the subdivision at all. See? I mean, there's nothing. This got to be a small subdivision. All right, so let's hypothetically say, okay, you guys, what I have to do is we're going to hypothetically put some info down because it just so happens that one comp that I picked, I need to do a lot more research on it. So what I would be doing, and again, I'm not going to do it because of the sake of time. So when I run into a situation like that, you now need to go into nearby subdivisions because in order, you need basically 3 comparables in the subject property subdivision that are within a year old. We don't have any of that in that subdivision. So therefore, I can now, more than likely, I am now permitted to go outside of that subdivision to find comparable data. Appraisers hate doing that. But again, they have to do it if there's not enough subdivision, if there's not enough comparable data in the subdivision, which is what we have found. So I'm going to hypothetically say that homes are renting for, let me throw this up here. Okay, we're going to say rent is, let's say hypothetically $105 a square foot. Okay, so that's our rent. And then the top is the price per square foot to sell. Okay. But again, we need wedge and cash flow, but there's one more thing that we need. You guys remember what else do we need? We need to quickly calculate our mortgage payment. Okay. So I'm going to call my loan officer, but if my loan officer is not available, all I'm going to do, you guys, is I'm going to go right here. And all I'm going to do is I'm going to put in my home price, which is $175,000. Okay. Let's just say I'm going to put 10% down. All right. And boom, boom, let me make sure my property taxes are updated, 5781. I'm going to increase homeowners insurance because, my God, it's not going to be that low, $1,200. It automatically calculates my mortgage insurance. And that gives me a principal and interest payment of $1,683. So I'm going to go here. I'm going to put mortgage. Okay. Is $1,683. You guys got to bear with me. I'm doing this live, completely blind. Okay. So now what I'm going to do is, you guys, let me look at you when I'm talking. I want to look at you guys. Let me switch this. So I'm going to go here. I'm sorry. All right. Brain's not working properly. So now we're going to calculate wedge and cash flow. Okay. Because now we have enough data to calculate these things, because remember, you guys, this is simple math. You don't have to buy, you don't have to buy a $10,000 course. You just have to know how to use a calculator. So what I'm going to do is I'm going to multiply 132. Okay. Because remember, that's what price per square foot is hypothetically average over the last 365 days. However, we know in this situation that comp is technically too old to use for appraisal value, but we're going to do it anyway. So we're going to take this square footage right here. I don't know why I put a dollar sign right there, but we're going to take that square footage and we're going to multiply that by this number, okay, which is $132. So we're going to take 1748 times 132.72. That's going to give us a total of, this is a good one, I'm going to put this above wedge, 231. This property does have wedge, actually. Again, I'll do more research on it, but because this was a comp, I just can't use it. Okay, so that's what that would equal there. Now, in order to calculate the rent, the market rent, I take the square footage and I multiply it by the cost per square foot it takes to rent. So again, I'm going to put 1748. I'm going to multiply that by $1.05 a square foot, and that gives me for rent 1,000 for potential market rent, right? We're looking at potential market rent hypothetically. All right, so now I have those numbers. Now all I have to do, you guys, is take the sales price. Well, I'm sorry, we're going to take this number right here, and we're going to minus the sales price to calculate our wedge. And wedge, remember, is just equity. You're just moving into a property with equity. That's what wedge means. Wedge equals equity. So that means hypothetically, when I subtract those numbers, we would have for wedge $56,000, almost $57,000. Okay. Now this is very, very important, especially if home values go down. If home values go down, you have a cushion of $56,000 in wedge or equity. So I can find this. I can find this constantly in my market. Where I struggle, though, depending on the price point, because remember, different price points, different situations, I struggle with cash flow anytime I'm over about 350. I can find wedge all day, but cash flow is another beast. So if now we're going to figure out cash flow, we take this number and we subtract the mortgage payment. Okay. Now this is going to be your gross cash flow because we're not counting maintenance fees and like property manager and things like that. But we subtract those two numbers, and that gives us positive cash flow, barely, okay, of $87. Now, how do you increase your cash flow, you guys? How do you increase your cash flow in this situation? You increase your cash flow by putting more money down, right? So if I wanted to get my cash flow up, all I do is I put 10, 15% more down until the numbers work. Now, honestly, guys, I'm telling you, wedges, I mean, I see you, Les. I mean, wedge is important. Wedge is really important, again, especially in a super toxic housing market. So if that made sense to you, please type M. That took so much effort to do, and I get so nervous because it's live. I don't know what's going to pop up. I'm just taking your comments, and I'm doing like realtor stuff, but I hope you guys like that. We're going to go into our next video. Can you guys just type in, type in wedge. If you know what wedge is now, please type in wedge. That's my gauge. You guys' comments is my gauge to, how I'm doing this. Okay, good. You guys are getting it. Good, good. All right, so wedge or M. Good, guys, good. I want you guys to learn, because remember whose decision is. This is your decision. You guys got to figure. I'm not thinking for you. I'm just a normal person. You guys got to decide these things. So empower yourself. Use these tools. Good. I'm glad you guys are getting it. Good. I worry so much sometimes. I hate wearing my heart on my sleeve. All right, we're going to go into our second video right now, you guys. This is from Danielle DiMartino Booth. She's going to go into inflation. This is a great video. It's about 6.5 minutes long. It's a little bit longer, but bear with it. She's just an absolute genius. So we're going to listen to that right now. And again, she's going to go into inflation and how crazy the market is. Thank you, Johnny. I see you. Hedge. Are you serious? Johnny, he's always trying to get reaction out of me. Let me know that the audio is okay.
Daniel, it's, I think it's really interesting because there's so many reports, call it anecdotal, call it what you will, that the consumer was strained. In fact, we saw last Monday where we saw a dramatic decline, for instance, and credit card debt, right? It felt like the average person out there was suffering and painfully dealing with things, and they keep telling us inflation is too high. Wall Street keeps telling us it's not too high. The White House keeps telling us it's not too high. Well, guess what? It's too high, isn't it?
It sure does look like it by the official numbers, Charles. And I think, I'm not going to take anything away from what consumers are shouldering right now. Some of the only areas really that we've seen of growth in consumer spending, according to a great proprietary survey that Morgan Stanley runs, has been in food that they're buying at home, truly the essentials. Every other kind of discretionary spending category, from eating out all the way to travel, we've seen more depressed spending plans coming out of households. And we did see, that earnings are negative when adjusted for inflation. That means that people have to cover what they must pay for, their essentials for their household, and they're pulling back on what is non-essential. We're hearing rumblings of that today from Marriott Corporation, even though in the CPI we saw a big pop in hotel CPI. We have to remember, Charles, these are number crunchers, statisticians with really bad models. There's a lot of lag effect. We finally saw the last few months of used car price declines come through in this latest CPI figure, as opposed to the last few months when they actually occurred.
So, but to that point, though, and let's start with the idea of these models, Danielle. We've had this conversation before. You've pointed it out. Over $1 trillion in unaccounted money that poured in through programs like PPP and other programs that will never be returned, ostensibly for people to go out and spend it, and they did. Some of them saved their businesses, some bought yachts with it. I mean, $2 trillion for COVID relief when COVID was no longer a major economic issue. When you start talking $3 trillion and then layer on top of that, hey, while you're at it, don't pay your student debt. While you're at it, you don't have to pay your rent. While you're at it, go out and have fun. Everyone on Wall Street started talking about vibe, right? Oh, how the vibes are. And when the vibes are good, everyone on Wall Street digs it. But when the vibes aren't good, they say, well, they dismiss it. These people don't know what they're talking about. They're living much headline after headline telling Americans how great they have it. Well, now we're starting to see some of it in the CPI report. And by the way, it still might be understated in things like food.
It still could be, Charles, but I do watch my weekly old-fashioned in a hard newspaper circular from my local grocery store, and it's getting thicker and thicker. In other words, I'm able to buy more things on sale than I was a year ago, with the big exception of beef. We know that the size of the cattle herd in the United States has come down appreciably. That just means substitution effect going forward, because boy, can I get chicken cheap.
Right.
So, but yes, you're right. People's grocery bills are still so much higher than what they were when the pandemic hit. But I'm listening to the National Federation of Independent Business, Charles, what they had to say this morning. They're concerned about sales getting hit. They're concerned about rising joblessness. Your average man and woman on the street, they're aware that their neighbors are losing their jobs, that it's been some crazy Game of Thrones competition in corporate America with this latest earnings season to see who can cut their head count by the most. So your average working man and woman, they know that their grocery bill's still higher. They're scared because their neighbor's losing their job. And so they're cutting back on absolute essentials. And that is what one consumer goods company after another has told us. And now we're starting to hear from the hotel chains as well.
To Jay Powell, now to his credit, he only laid out 3 rate cuts. It was Wall Street that assumed 7, then 6, then 5, and I think now 4. You've been you've actually defended Jay Powell somewhat here in the last few months. It feels like between what he said, even back in October, but more recently to curb the enthusiasm on Wall Street, maybe he knew that the street was ahead of itself here in terms of all of these rate cuts that they were building into the market.
Look, I'm going to tell you that everything I just talked about with how the average person is feeling on Main Street, that has nothing to do with Jay Powell. Jay Powell knows that the Federal Reserve, that the size of its balance sheet, that footprint became way too big. And he is a man on a mission to reduce the size of the Fed's balance sheet. In order to do that, Charles, he has to lower interest rates to the least extent that he possibly can. So if we're pushing the first rate cut out now to June, that bodes better for him and his mission, because he knows that the Federal Reserve became too big a component in the economy, too big of a component in facilitating largesse on the part of our
Danielle, Daniel, sure. I gotta move here, but you're talking about, you just mentioned Congress, a $95 billion aid package to Ukraine. They're not going to stop spending. So I get where Jay Powell's coming from, but real quick, hasn't the Federal Reserve already crossed the Rubicon? I don't think they're ever going to get themselves extricated out of this economy to the extent that they're in, including the need for free money from Powell and company, or no matter who the chairperson is from time to time. And more QE, more rate cuts. Wall Street loves it. Main Street needs it.
Maybe, Charles, but we've just got March, April, and May for Jay Powell to have 2 years on a mission of constant tightening. 2 years is not nothing, given his predecessors and their years and years and years and years and years of quantitative easing. So I understand where you're coming from, but he is still making progress. The progress has not, I don't see a rate cut yet, and the Fed's not stopping on shrinking its balance sheet. So let's not throw the guy under the bus just yet.
All right, so let's not throw the guy under the bus just yet. Remember, you guys, go to Danielle's channel. I got that off her YouTube channel. I'll link it in the description. Very good perspective right there. But my question is, and let me know what you guys think. I mean, I understand, like, okay, Jerome Powell has to be very tactful. He has to be a great liar, a great manipulator. It's kind of a part of the job, I guess. But do you guys think that maybe, they didn't raise rates enough? Do you guys think that that's possible? Do you think that maybe we should have been in 8% longer? Do you guys think that, you guys think there's maybe a second round of inflation coming? Tell me what you guys think below. Maybe we should have had interest rates higher. Now, I know Danielle, is rooting for Jerome, and he has been consistent, and thank God that he has, but the story's still being told, right? We still don't know 100% whether or not Jerome is going to end up doing a good job, but we do know that we're in this situation because of the Federal Reserve. So he is part of the problem. Now, hopefully he will be part of the solution. We don't know that yet. But keep listening to her. Good perspective. Again, we're going to move on to the liquidity update, and I'm going to show you guys some markets that appear to be rebounding ahead of spring home buying season. This is crazy. But also, and then we're going to go over and watch the video on the fact that the UK and Japan entered recession. And generally, whatever happens in the UK is then going to happen to us, right? Like UK is like that gauge where, it's going to happen to them before it happens to us, and that just happened to them. Right? You guys agree with me on that? Maybe I'm wrong. But look to UK, because is going to happen there first. And they just went into recession. But first, let's go over again the liquidity update. I'm going to start by showing you guys and talking about the inversion because it's the same inversion. We're now over 19 months. We've been, inverted for over 19 months. And again, that's what the inversion means. The 2-year is higher. The yield on the 2-year is higher than the 10-year. So it puts us inverted. This is killing banks. It's hurting them. They can't make as much profit. This is an indication that we are entering recession. Okay. That's what I'm talking about. This is an indication. Now, here's the thing. We have been inverted over 19 months. That's a long time. And it makes sense. Why? Because the overwhelming amount of money printing, none of us can really fathom how much money was printed and really the causes and effects of the money printing and the quantitative tightening. The market is split. There's some segments of the market's doing well, some metros not, some subdivisions are, some subdivisions are not. It's really a hard read, and that's why you guys got to really dip. Multifamily housing starts dropped. Okay, I didn't do the multifamily, Jack. Okay, you guys, this is my dude right here. Okay, this is my dude right here. Jack, I love you. Jack and Todd are so cool, you guys. This dude, when I got to him, I was so intimidated. Jack is huge. This guy's like Hercules. I'm not joking. He's like Hercules. He's a firefighter. I love this man. Jack, I love you. Tell them it like you're Hercules. The first thing I said is like, dang, Jack, you're in great shape. Tell them, Jack. Tell them. But we are inverted, you guys. We are drastically inverted still. Not drastically. We're starting to do reversion, but we're stuck here. We're stuck here. We don't have our bust. We don't have our inflation. My God, this is crazy. Now, take a look at the reverse repo market. Reverse repo market's like the springs. I love you, Jack. It's like a suspension system. And I love how Danielle DiMartino explained this. This is our suspension system as the car is going down the road, hitting bumps and pop holes. This is what's absorbing that shock, if you will. And we were at 2.5. I think we're at 2.2, about 2.5 trillion dollars. You guys, we've now hit the 400,000s. Billion, 400 billion, but right now we're at 493. This is going down quickly, Jack. Correct me. I know maybe you don't think this, maybe you do, but I think we're going to go till May. I think this is going to have money into it till May. Keep your eyes on that because that is a ton of suspension. That's a ton of liquid money, right? Take a look at what the Yellen's doing. They're selling, you guys. They're selling treasuries. Because you can see the U.S. Treasury general account is going up, not down. So that's interesting. You guys agree with that? So they're selling treasuries. They're getting money, and probably also the taxes are going to come in as well. But the Treasury's got money. They got $838 billion right now. So keep your eyes on that because that is another round of additional liquidity that is going to eventually be injected into our economy, obviously. Now, here's the MBS, mortgage-backed securities. This is a huge. A lot of people are upset about this. This is one of the things that Danielle hates, the fact that they purchase so much mortgage-backed securities. When the Federal Reserve purchases mortgage-backed securities, they artificially manipulate the mortgage market. Okay, so they're manipulating the mortgage market. This is a very bad thing. They said they were going to sell. They're not selling. They're letting things roll off. So that's why you don't see a drastic decline. But look at the run-up in mortgage-backed securities. This is the quantitative easing. So this is what quantitative easing looks like. And I guess you can call this quantitative tightening because they're not purchasing assets or mortgage-backed securities. Very interesting, you guys. But they still have a ton. They have $2.4 trillion in mortgage-backed securities. Now, let me show you guys what's been going on in the markets. Okay, I want to show you guys San Francisco because this just updated. So January just updated. Okay, so it's been I don't know if it updated today or yesterday, but it just recently updated. Now I'm bringing San Francisco up, okay, because right before it updated, San Francisco was showing down year over year. I don't remember what it was. Was it like 18%? So I just want to let you guys know in 1 month it went from being down year over year like 18% to up 7.6%. Now, I want you guys to pay attention to this bump right here. This is what I'm telling you guys that I'm concerned about, okay? You're going to be hearing a lot of noise, and I'm giving you guys a warning. Because remember, it's your decision to buy. Your market's different than my market. Your goals are different than my goals. You got to do your own thinking for yourself. I'm only providing you tools and perspective. And what I'm noticing, and my perspective is right now, is the market has already started rebounding ahead of spring home buying. And that makes sense because the market's all over the place. I mean, we're getting inventory when we're not supposed to. Home prices are going up when they generally go down. This is a huge bump month over month, you guys, ahead of spring buying season. This is a massive run up. Look at this in 1 month. That scares me. That's probably why inflation's back. Okay, that's probably why maybe rates need to be higher, because they're coming back out. You guys are coming back out. And look at, normally, if you look here, it goes down from December to January. Do you see that? Not always, but normally it goes down, not shoot up. That's shot up. Okay, and look at back here. Same thing here. Look at, from December to January, it went down. You guys, I'm worried. I'm worried right now that people are going to be foolishly purchasing, and we're not going to have the inventory come back, and these people are going to be trapped. Now look at this one. This one is Wake Forest. This is crazy. This is where I was actually doing a boots on the ground. Now, in December, this was down 19%. So in 1 month, it went from down 19% to down 13.1%. So even in the markets that are distressed, even in the markets that are apparent, going down in price, it's still rebounded. Look at, from December to January. This is a rebound. You guys got to keep your eye on that. And one of the reasons this may be is the investor demand has shot up for affordable housing. So just all I'm saying is guard your heart, keep focused on the data, stay patient, because you guys are going to hear a lot more about this. All right. But that's insane. Look at this last one. This is Anaheim. Same thing in Anaheim, guys. And I pulled up Anaheim because I want to point out, in Anaheim, California, from December, again, from this, look at the run up. This is ahead of spring home buying season. It's not supposed to run up right now. You guys, I'm not trying to scare you. I just want you to be aware. And that's probably why higher rates for longer. Higher rates for longer. People are still spending. And not only that, in Anaheim, you guys, not only that, Anaheim hit a new high in January. In January of 2024, I kid you not. Okay, looking at Redfin data, January has a new record high in January. That's scary. That's crazy. That means that people can still spend. It's probably not the younger kids. It's probably boomers and people that are well off. But my God, you guys, do you see these rebounds? These are markets I've been watching. So when it updated from December to January, I was like, my God, it's insane. So just like I said, everybody be cool. Everyone be cool. Okay. Keep your guard up, because, and another thing, I'm not just basing that off of Redfin data. I'm also seeing that in Kingwood. In the market that we've been watching, I've been seeing more houses under pending than this time last year. In fact, I have less inventory now by like 10 or 15% in the Kingwood market when we compare to last year. So they're coming back. Now, will these interest rates in the 7s stop the market like we hope? I certainly hope so, because there's almost no fundamentals in purchasing right now. But there's, again, you guys, you really got to take the data seriously. You really have to understand that I'm covering entire housing markets, but when it comes to your purchase, you got to go subdivision. You got to go hyper local. All right. So just understand that. We're going to listen to our last video right now. This is a Bloomberg video. This is on Japan slipping into recession. And I hope I'm doing okay with my energy. I'm sweating like crazy. I'm still sick. For sure, if you guys can, let me know that this audio is okay, and then we're going to end with the Q&As, but take a listen to this.
Script, what's the path ahead for the BOJ?
That's right. This is not the result anyone was wanting. This is the perfect headache for the BOJ. After all, this carefully coordinated build-up to this first interest rate hike since 2007. And then just as you're expecting the green light to come on and say go, it stays red. And not only that, it's worse. Now just think about this. We've got 34 economists gave us their forecasts for GDP. Only one said there was a chance of contraction. There's quite a few around zero, but only Daiwa Securities called a contraction in that quarter. So we're in technical recession. Which central bank in the world wants to raise interest rates when the economy is in contraction, is in recession? It's not a good look, is it? So the optics are not great. But I would caution against saying that this means, okay, no rate hike until the summer, until we've got a quarter of growth. I think we're still on track, but obviously this does complicate the picture. And if we look at overnight swaps data since the figures came out, we'll see that the kind of probability that market traders have for a rate hike by April has dropped from about 73% to about 63%. Let's just keep an eye on how expectations change. But certainly, I think the BOJ is going to have to do a lot of explaining if it wants to carry on with its rate hike with an economy in recession.
Is there some angst with dollar strength and yen weakness too? Does that complicate the outlook? Because, you know, it's an easier way to give support to the yen if they were to move sooner.
Yeah, well, I mean, if they move sooner, that does help the yen. But then, you know, you've been doing this incredible monetary stimulus project for more than a decade. Do you really want to be looking as if you're responding to some yen moves right at the last minute? It looks like a kind of knee-jerk reaction at the wrong time. So I think the optics don't look good for that. And don't forget that the weekend does help on the trade figures. And let's face it, that's the only thing that was good in the results today. I mean, consumption's down, businesses are spending less, households are spending less, and it's for 3 straight quarters. Does that look like a positive growth cycle to you? Doesn't to me.
All right, guys. So, in other words, the world is in bad shape, and again, kind of UK had to go into recession right before us, right? You guys see what I'm saying there? I don't know if that makes sense to you guys, but what I'm going to do is I'm going to go into the Q&A part of the video now as fast as possible, as well. And real quick, I see you, Comic. So the thing is, Comic, it's just the pettiness, brother. I mean, I love you being around, but like, dude, the complaining is just, I love you though. So Comic wanted me to do the drop down on right here. So you guys can obviously go here. Like I've been saying from the very beginning, I'm not sure why this is confusing. And Comic, I do market analysis as well, which is localized. I actually do that for free. People charge a whole bunch of money for those courses. But all right, so let's remove, so this is San Francisco. Let's remove the condos and townhouses, which is over 50% of the housing stock. So we're just going to remove 50% of the housing stock and looking at houses. So again, look at this. You see the same thing. You see this run up. Peaks way up here. Now there's 86 single family homes as compared to 1 townhouse and 106 condos. So I would actually say if you do what you're doing in San Francisco, you're definitely commingling your narrative with the numbers. I'll use the word commingling because you love using that word, brother. But anyways, guys, if you really want to kind of just pinpoint like single families versus condos, there's a drop down there. I'm pretty sure like everyone knows that. It's a big deal to Comic. So there you go, Comic. I did that, man. Friday, beer on me. I appreciate you, brother. I don't drink beer usually unless I go to New York with Todd. But I appreciate that, man. I'm going to put that in my kids' college fund. You know what I mean? My God, I got to save money to my kids through school. So that's kind of a scary thing. But let me go into the Q&A right now, you guys. I'm so sorry for rambling. I just wanted to cover that one thing real quick. I start some really good stuff here. Again, fish and trips right now. Really, really appreciate that. Really appreciate you as well, G. Yeah, you guys don't have to do that. It means a lot to me. Let's go here real quick. Here's our first one. If the Fed raises rates, banks will cut lending and increase layoffs. My friend that's a high up at a bank is begging for rate cuts because he knows bank jobs and lenders are on the line. And this is exactly right. And you guys remember the market's not anticipating any rate increase. So if we do have rates go up, that's not going to be good for the banking system. And we will eventually get our credit restriction. We don't have that right now. We don't have credit restrictions. We see that in the slosh reports. It's not even restricted. You see the restriction in commercial, you see the restriction in subprime auto, but you don't see really restriction in mortgages. I would argue that it actually loosened. If you look at FHA reduced their mortgage insurance. And by the way, you guys, I'm going to tell you right now, there's only one reason why conventional mortgages are better than FHA. There's only one reason, because remember, FHA mortgages generally have a lower down payment unless you do Home Possible and Home Ready Conventional. So FHA generally lower down payment and almost always has a lower interest rate. So FHA, lower interest rate, lower down payment. Why the heck would anyone want a conventional? There's one reason, and that's it. Mortgage insurance. That is the only reason basically that conventional is better than FHA, mortgage insurance. With FHA, it can be lower, but with FHA, mortgage insurance never goes away, ever, unless you have 10% down it goes away in 11 years. With a conventional mortgage, it will go away once you have 22% in equity or 20% down payment, or you write into the lender and ask for the PMI to be removed at 20% equity. You have to write in. If you don't write in, they can go up another 2% to 22%. So that's the one reason. Good comment though, Dean. Okay, my man, Real Estate Mindset. Someone recently told me about recasting. Okay, so this is a crazy new thing that they're doing. Some lenders allow you to recast your mortgage within a year if you want to put more money down. And that's actually, recasting a mortgage is incredible. It's actually something, depending on the fees, you should take advantage of because it will lower your payment. So say you purchase a house, you move in, but then you saved an extra $20,000. You can actually put that down on your principal and recast that mortgage to take advantage of lower payments. So I think recasting is actually, it's shocking that they're allowing that. Where the heck am I going to get an extra $750? I don't know your situation, but I would say probably by canceling subscriptions and probably never going out to eat again. Seriously, Merck, I want you to do your budget. Am I right? If you canceled every one of your subscriptions and stopped going out to eat, would you get an extra $750 a month? Test me. I'm calling you out. I want you to look at your budget right now and tell me. Say, no, I'm not spending that much. Yeah, you're spending that. You're spending more than $750 on subscriptions and going out to eat. Probably. Maybe you're not, but you probably are. And that's where I would suggest you look for that money. But I know it's hard times, man. I mean, I feel it myself. I was stressed out the other night just thinking about how much harder it is to afford to live. Another comment, low mortgage rates, they took advantage because they were smart, lucky because 2021 government printed pumping home volumes. So this was the point I was trying to say, that most people that were purchasing in 2020, 2021, 2022 were lucky, and they were 100% lucky because I can guarantee you no one that was purchasing knew that it was like, okay, so 2021, 2020, 2021 were record-breaking years of equity growth, topped with the lowest interest rates in history as a result of lockdowns. Raise your hand if you think buyers knew that. Did the buyers know that they were going to lock down and it was going to be historical equity growth? No, they did not know that. They got lucky by purchasing. And when they say savvy, no, the thing is, guys, how do you guys not, with the fear of missing out? There's no savviness in the fear of missing out. They had a low interest rate. There's some people that purchase savvy, but do you really have to be savvy when rates are 2% and equity has been going up 20% a year? Do you really have to be savvy? Think about it. You got to be savvy right now because of how toxic things are. Back then, you just had to get your offer accepted. I'm just saying, that's just my interpretation. That's just my interpretation. And there's my man again. I'm back. Keep grinding on YouTube's be such a heart. Yeah. So right now, again, you guys show this man some love. You didn't have to do that. So this is a comment from Les. Wedge is king. Why do we care about cash flow? How do you not know that, Les? I've been talking about this all the time. You're my boy, Les. You're the guy. I'm like, man, I hope Les is okay. He's spending a lot of money on those cruise ships instead of saving money. He's literally doing the opposite of what I'm saying. You're doing the opposite of what I'm saying, Les. I just want you to know that. But why do you care about cash flow? What if you have to move? Say job relocation, say you can't afford your mortgage, say you're upside down in your house, so you don't have that wedge. How are you going to move? How are you going to move? You can't. You can't move unless you bring money to the table that you probably don't even have. If you want to move and you're upside down in your house, you can turn your home into a rental so long as you cash flow. So cash flow is important if you have to move, but you cannot afford to sell your house because you're upside down in equity. Cash flow is just another safeguard that I'm trying to teach people about, Les. And I know your cash flow is horrible because I know you'd be going on those cruises all of the time. Stop going on cruises, darn it. All right, living in Omaha. When you look at price per square foot, do you separate existing from, so living in Omaha, so I'm doing subdivisions, okay? So if the subdivision is new construction, then I have to use new construction comps that are technically no longer new because they have just been sold. So you're gonna separate out new construction depending on the subdivision. You're taking comps in the subdivision. If the subdivision is full of condos, you're taking condos. If the subdivision is all new houses, you're taking new houses. If the subdivision is only SFR and they're existing, then you're only using SFR existing. You see my point there? So you're going in the subdivision. So generally it's the new home subdivision, not both, generally. So whatever's in the subdivision is my answer there, okay? You should know that. All right, Ray. Hey, Travis. Oh, sorry, man. I've already done that. Come into the next live and give me a heads up on that. Okay, I thought about it. I could really use the equity to put down on a new house. So someone told him to rent his house out because he's got a super low interest rate on his primary residence. And he's saying that he doesn't necessarily want to do that because he wants to cash in on the equity. And I'm going to tell you guys right now, I'm going to probably sell my house this spring. I have a rental house. I did not purchase the house to rent. I hate being a landlord. I don't want tenants. I'm probably just going to sell my house. If the market rebounds like it has started to already ahead of springtime, I'm gone. And I'll put my money where my mouth was. I will sell that thing and cash in on my equity and hold my money, put it in T-bills. If the market rebounds, you guys are going to witness that. I will sell that sucker this year. And also, I'm going to be doing my taxes this weekend to revamp my purchasing power. So I'm going to do my taxes this weekend, and then I'm going to do a final analysis of my market to decide whether or not to rent another 12 months. So I'm going to be doing that this weekend. Stay tuned for that as well. But again, I don't want to do that until I have revamped my purchasing power. Obviously, I'm not working a W-2 job anymore, so I want to revamp that. I don't know. So he's asking, what do I think appreciation or depreciation is over the next 10 to 15 years? It depends on the market and depends on the segments of the market and the subdivision. And 15 years is a long time. But I would say probably by 15 years, home appreciation will be going. I'll tell you what I want to see living. I want to see a correction, crash, whatever we want to call it, 15 to 30%. I'd like to see that. And then I would like to see, once we get through that, I would like to see normal appreciation. I'd like to see 5% appreciation. Overall, some markets will have way more, the tight markets way more, and so forth. But I don't know, living in Omaha. It really is going to depend on what happens in the future. My dad told me something a long time ago. This is a great saying. When you rent a home, you can rent a home or you can rent money to buy a home. Puts it in perspective. That's so good. So either you're renting the money to get the mortgage or you're renting the home straight up. The tax deduction, though, is the difference. So usually I can tax deduct the interest on the mortgage where I can't do that on my rent. I'm not a CPA. This is such a good point, FG. Great point right here. And this is really what I'm like, oh my God, be careful. One paycheck not coming in is going to destroy a certain percentage of homeowners. Homeowners are tapped out, even if they had a 3% rate. Not all, but there are a percentage of consumers that take that savings and they go buy a new car. You guys, if just one person that's paycheck to paycheck loses their job, it's game over. It's game over. One month of missed wages is game over for a high percentage of homeowners. Now, if they purchase and they have their 6-month cushion, they have no consumer debt, right? They have job security, they bought with wedge, they bought with cash flow, they'll be better off, right? But think about what FG's saying, you guys. He's not wrong. One missed payment, you're dead in the water. You're dead in the water. One. Think about it. And that's what happened back in the GFC, you guys. It wasn't the subprime. The subprime only accounted for about, I think it was 24 to 26%. Everyone's like, no, the subprime collapsed. Like, no, you guys, consumers could no longer afford to pay. They couldn't get a job. They couldn't pay. Subprime was only like 25% of the market. 25% of the market right now, you have FHA, you have portfolio. The defaults are up. The delinquencies are up. There's only 1 out of 4 loans were subprime. It's the convention. It was the prime mortgages. It wasn't just the subprime. The subprime contributed to that problem. I'm not saying it didn't. All right, here's the last comment. This is a good comment, you guys. Man, I'm getting out of breath. I'm still sick. Okay, real estate mindset. Isn't inflation going up because, okay, Israel, Ukraine. Here's the thing with this comment. I don't want to get politically polarized, you guys, because I love you guys more than that. I think politics brings out the worst in us, and I think they're all a bunch of liars, and it's the best of two evils, and that's all I want to say. I don't ever want to even tell you what party I'm going to vote for, although you guys probably know. Everyone's a liar, and it's just so depressing. But here's what's happening, you guys: deficit spending. So on one hand, the economy appears to be great. That may be a dog and pony show, because if the economy was great, we wouldn't need so much deficit spending. Deficit spending right now is out of control. And for sure, here's what happens. When they print money to fight a war, and I'm not going to go into the wars, okay, but I'm going to tell you the process. When they print money to back up a country to fight a war, they're giving them money to purchase American weapons. And so what happens with inflation if that happens? Inflation goes up. And if inflation goes up and prices go up, who's paying for the war? Who's paying for the war? The more deficit spending, the more that they give other countries and those countries buy stuff from us, the inflation is just going to get worse and worse and worse. So although we feel it in Main Street, we feel this in Main Street. We feel this. The government is printing so much money. There's so much deficit spending right now that the economy, in my opinion, that's why the economy appears great. I don't think it's great. I think it's the government. I think it's deficit spending and topped with the money printing. I mean, they're literally fighting against quantitative tightening. That's why, again, 2 years quantitative tightening barely even shook us. It did shake us, but not to the extent we thought. Recession. We haven't even had recession. So anyways, guys, that is that part. Again, appreciate you for the super chat. We send them money to buy real estate. I don't know about the real estate thing, man. You know, I don't know enough about that. I don't know if they're using money to buy our real estate. I would be interested in finding that out, but I'm going to get out of here, you guys. Get some rest. But I really appreciate you guys joining me for this Friday. Stay tuned for Monday. I want to finish the week and start the week with you guys to give you a full update. Everything will be chapters, so you can come back here. Bernie, man, you're funny, Johnny. And again, you guys just have a great weekend. Remember a couple things. If you're out there shopping for a house, just be cool, be calm, and understand your local market trends. Whether you be looking for a townhouse, condo, SFR, just understand your local trends if you're out there shopping. If you're on the sidelines, remember, it's how you wait. Wait with a purpose, as Orlando says all the time. Increase your purchasing power. Understand your local market trends. If you already own a home, just buckle down. Change the way you're saving. It's not the end of the world, but buckle down, all right? And again, I want to end you on this, okay? During the weekend, let's work on, you guys are going to clown on me, I already know this, but let's work on improving ourselves. Let's work on enhancing the relationships we have in this world, because the relationships we have are more important than houses and are more important than money. I conquered money by losing everything. I don't want that to happen to you. The more important thing is the love. The more important thing is our family. Know that. I know that. Do you guys know that? It's still hard for me to wait. But I love you guys. And if you're out there investing in real estate, you guys already know I wish you luck and I hope you win.